Reliance Industries delivers a beat on EBITDA and profit in the third quarter. The oil to chemicals business records strong growth along with margin expansion. Jio's ARPOs improves while retail continues to grow at a steady pace.
Another record-breaking quarter for ICICI Bank. Net interest margin comes in at a lifetime high, whereas asset quality is at an 8-year high. Kotak Mahindra Bank too reports its highest net interest margin in years, with asset quality coming in over a 30-quarter high. Both stocks higher by about 1%.
Ultratech Cement reports a largely in-line quarter. However, realizations disappoint. The volumes remain solid on the back of resilient demand.
We also have IDFC First Bank and Bandhan Bank, both of them in focus. IDFC's numbers just about beat estimates. The management remains optimistic of net interest margins above 6%, whereas Bandhan Bank surges despite a sharp decline in net interest margins. This, as the management tells us, that they expect the margins to improve to levels above 7.5%.
It was a mixed quarter for Yes Bank, but a Bombay High Court order quashing the writing down of AT1 bonds worth around 8,300 crores sees the stock react with a cut of around 9%. The management, however, tells CNBC-TV18 that they will appeal against the order in the Supreme Court.
Hello and welcome. You're watching us here on a fresh news edition of Chartbusters. I'm Bangla Malu, with me Nigel D'Souza. We opened well, we're meandering around mildly in the green, but then we have a bunch of stocks which are doing well and a lot of them which are not. The Sensex virtually at the high point of trade, and as is the Nifty, 18,150. Levels upwards of this, will there be resistance or can there be case for further short covering or not, is the big question we will ask Shivangi Sada, who joins us. Shivangi, thank you so much for joining in. We've been in this 18,000 to 18,150 sort of range for the last 3 or 4 trading sessions. Your thoughts now that we've opened, and seen some pace pick up, do you think we're likely to go higher from here?
Good morning, Manglam and Nigel. Thank you for having me on the show. So we've seen that there has been good amount of support-based buying in the index in both Nifty and Bank Nifty. So as far as Nifty is concerned, we've seen that it has surpassed its previous day's high very efficiently, and buying can be seen at any declines. So recommending a buy from here because we do expect a more upside from here. All the data points are quite positive. The Nifty PCR OI has cooled down, which gives a room for a more upside over here. Long-short ratio of the FIIs have also improved. Overall, the option data also looks towards the positive side. So we could expect 18,250 and 18,350 levels over here with the support of 18,050 levels. As far as Bank Nifty is concerned, we've seen that, from the last 4 sessions, we had seen some sort of underperformance, but then again, now it is taking good amount of support and moving ahead with support of, some banking stocks which are outperforming. Now, we've seen that, even after the gap up opening today and the global markets, giving a tailwind to the index, it is sustaining at higher zones, and we could expect 43,500 from here, at these levels with a support of 42,750.
Okay, all right, Shivangi, thanks so much, for joining by and in fact giving us your call on the index. And clearly, you're sounding fairly positive out there. But individual stocks, what are you looking at?
So my first pick would be on GAIL. We've seen that it surpassed its resistance zones of around 99 levels, and it has been a consistent outperformer because it has been making higher lows from the last 4 months. Now it is trending in an upward channel on the weekly frame as well. In the December series so far, we've seen short covering move which could drive the stock higher to around 106 levels with a stop near 99 levels. Now my second pick would be on M&M. We've seen that it is coming out of its consolidation of the last 9 sessions on daily frame, and in this series we've seen 24% open interest addition with price rise, and clearly it is coming out and holding well at its higher zones. So expecting a more upside over here to around 1400 levels with a stop near 1315.
All right, thanks a lot for that. So that's about her call. So with that, let's shift focus to our special segment called Ideas for Profit. This comes in from our colleagues at Money Control Pro, and today we have Lekha Badlani joining in.
Yes, thanks. So I'm going to talk about Rallis that recently posted a weak third quarter results, but we believe the reasons were largely known, as Q3 is seasonally a small quarter for Rallis and the entire agrochemical market suffered from high channel inventory. Now, having said that, we believe there are reasons for demand to improve in the next Kharif season of FY24, as domestic demand should improve owing to favorable outlook for the upcoming rabi season and lucrative crop prices. Exports, although will remain challenging in the near term, we believe it will again improve in the next fiscal. Apart from that, other concerns pertaining to high cost inventory and supply chain issues have also eased off now. The crude oil prices have fallen about 29% from their peak, and other crude linked raw materials have also corrected recently. Now, this will apparently be good for the margins. There will be pressure on the product pricing as the market continues to seek better pricing in line with the fall in the raw material prices. Now, Q4 is also a small quarter for Rallis, but with new high-value product launches for the next Kharif season, we expect improvement in Rallis's business in FY24. Now, if you see, the stock gave up almost all of its 3 months gain in last 2 days and is trading at a PE of 19 times our FY24 projected earnings. Now, after the correction, we believe the stock has turned even more reasonable, and we advise investors to accumulate it at current levels.
Okay, all right. Lekha, thanks a lot for giving us that quick update on that particular stock. For the time being, though, we'll slip into a short break. But on the other side, we'll be joined by the management of Ramkrishna Forgings. They'll be detailing their numbers and the way ahead as well. Welcome back here, tuned in to Chartbusters here on CNBC-TV18. Well, the markets are looking quite good, but earnings season, so results are coming in thick and fast. And we got a number over the weekend, that's Ramkrishna Forgings. They saw margin expansion in the third quarter, along with the profit growth of close to around 35%. The volumes too registered a good growth, along with expansion in realizations. Now, to tell us about the past quarter, what's the way ahead as well, we're joined by Mr. Lalit Ketan, the Executive Director and Chief Financial Officer of the company. Hi, Lalit. Thanks so much for joining in. Well, give us a couple of details first on the tonnage front. I'm looking at the 9 months. I think you've done close to 96,000 tons. What do you end this year with? That's FY23. Last year, you clocked around 111,000. And given that you have a capacity expansion, which increases your capacity by close to 25%, what's the outlook on volumes for FY24 and FY25? Go ahead.
Yeah, so FY23 looks quite good in terms of volume, and we expect further expansion in volume, what we did in Q3 in Q4, and at least 15 to 20% more in FY24.
FY24, 15 to 20% growth.
Yeah, minimum 15 to 24% growth we are looking in FY24.
And 25, you'll have the entire capacity that will be available, right? For FY24, you'll be having this extra 56,000 tons or only for half the year. But for FY25, yes. What kind of a number are you looking at?
So see, we are looking to grow at a CAGR of around 20%. Okay. So that should be the number.
All right. You do have a potential revenue target of almost 5,000 crores by the entire capacity that comes in as well. But, you know, let's talk about the acquisition bit, Mr. Khaitan, because you've also announced the acquisition of JMT Auto. What kind of revenue potential do you see from this acquisition? I mean, you've, the overall cost is 125 crores with 70 crores being paid upfront. What is your sense of the return that you can generate on this? I mean, one, the synergy benefits on revenue and costs and additional revenue that comes in?
Yeah, see, this will be acquired in SPV, and the additional revenue at the peak turnover can be anything between 500 to 550 crore. And I hope we will be able to get it on stream once we get the order from NCLT in 18 months' time.
And by when do you reach the peak revenues of 550 to 5?
It will take 2 to 3 years.
Okay, and what kind of margins do you see in this business?
Margins are quite good because they make a lot of value-add product in JMT Auto apart from forging. So I think margin will be much better. We will be looking at anything between 24 to 25% EBITDA margin.
Oh, very good. All right. So, and this is likely to be, so you're saying in the next few months, you'll take over this asset. In 18 months, you'll have full control. And post that, you'll ramp it up with margins of around 24 to 25%. We're getting that correct, right?
Little correction here. See, it depends upon the NCLT order.
When is that expected?
That's not in our hand, so the court has to decide. But we hope next 3 to 4 months max it has to come. Okay. And after that, we need to refurbish the unit and to do some repair and maintenance to plant machinery. and that will take us around 18 months.
So this entire acquisition gets closed out by the end of FY24.
Correct.
Got it. All right. Give us a couple of more numbers then. The debt reduction, for this year has taken place, I think close to 300 crores odd. You're hovering around 1,300 crores. Now, by the end of...
we are right now at, gross debt is around 1,300 crores. Yeah, correct.
Okay.
So we are looking to reduce 300 to 400 crore every year with the kind of growth we are expecting and kind of margins with the with the acquisitions we are expecting to at least 3 to 400 crore reduction in every year.
All right. As far as your non-auto business is concerned, railways and off-highway products, you had said that this could increase in contribution to your overall revenues. So how much has railways done so far? What's the projection there? And the non-highway business?
See, overall non-auto business is around 20% right now. And but railway is going to contribute quite significantly in FY24 and further improve FY25. And we have a target to achieve the non-auto to 30% by FY25.
And non-auto has higher margins. Is that so?
Yeah, little higher margin, the 100, 200 basis point more.
Okay. And defense, have you looked at that? Are you all getting orders from defense? Because that's another sector that we hear a lot of positive commentary and a lot of focus globally as well as here in India. So is defense another vertical that a potential opportunity could come? Or for the time being, I'm just looking at your mix, 80% is coming from autos, rail is only around 3%, and you have mining, earth moving, etc. That's around 8% odd. So does defense find a mention in here?
No, we are not into defense right now, and right now we are not looking at it also.
Not located. Okay, great. The other big point, Lalit, is that everyone's talking about European OEMs. They are looking at, getting new vendors. Could you give us a sense about, are there such vendors that are in the pipeline where business could flow, say, in the next 15, 18 months or so? Could you tell us that? And from the time of discussion, how long does it take for them to finalize on a new vendor, which Ramkrishna could be in some cases?
See, we are getting a lot of inquiries from the Europe, as what you rightly said, a lot of traction from the Europe for the new vendors. And see, if there is a new vendor, absolutely, the virgin vendor, it takes almost 12 to 18 months. And if there is an existing customer and who wants to increase its product portfolio, it can be done in 3 to 4 months time.
All right. And Europe is about 10% of your revenues, right?
Yeah, and we are quite hopeful to double this revenue in next financial year due to this.
All right. And, as far as the other acquisition that you've made, the one of Tuso, how much are you, expected to invest in all these acquisitions in terms of capex or funding, etc.?
See, Suyo we have to invest over a period of 5 years around 100 crore. So it will be over a 5 year, and that we will acquire 51% in a phased manner. And basically, it's an EV component player or a startup player which have a very good potential to grow. And with the support of RK Forging, we hope it will do wonder in the motor, controller, differential, and EXL space. And they have a good, they have a good capacity, and we will just ramp up and penetrate the market.
So is it basis this acquisition that you are hopeful of EV going from 2% to 5% of your sales, or this is over and above that?
This is over and above that. That 5% of sales is from the RKFL facility alone.
And this is another 500 crores that will come in from there?
Yeah.
All right. Thanks a lot, Mr. Khaitan, for joining in and giving us all those details. The street likes what you said, because as we speak, as you were talking, we had seen a bit of a spike up on the stock. Volumes for the next year, you are looking to repay debt as well, and going forward, 20% CAGR is what you've guided for, with higher contribution coming in from higher margin products. Take a short break, come back, we continue our coverage on the markets and individual stocks. Welcome back. Holding well for the markets. In fact, just pull up HUL. That's the stock which has moved to the high point of trade. Remember, it was down about 4% in the previous trading session. The street did not like the fact that they had increased the royalty by about 80 basis points. But underlying of that, there was good commentary that came in. The results were mildly better than expectations. So maybe at lower levels, the street is looking at improvement in the conditions for the sector, and perhaps also ignoring the fact that maybe a lot of the other MNCs charge a much higher royalty percentage. So as a result of which, we're seeing a bit of an uptick on HUL. But the other stock which is in focus is Bandhan Bank. That too is trading higher, and this despite reporting a weak third quarter numbers. Is the management commentary something to watch out for? Abhishek joins in to tell us more. Abhishek.
Well, as you mentioned, the management commentary was really positive. They did tell us that, the loan growth is expected to pick up from here. Around 20-25% is the kind of growth rate that they are going to see over the next few quarters. So to talk about the results, the MFI book has been declining, and the stress has also come from it, largely which is known. The net interest margin is at 20-quarter low, given the fact that there were interest reversal in this quarter around. So it has come in at 6.5%. The management has said that, going ahead, they will see net interest margin stabilizing at 7.5% or even more. Other income aided the PAT this time around, up about 45% YOY and about close to 117% sequentially. The asset quality slippages have declined quarter on quarter, and gross NPA ratio has also improved on a sequential basis. However, the P&L, both NII and PAT, is below our poll. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, on that note, though, we'll have to wrap up on this edition of Chartbusters, but you stay with us. Trading Hour comes up next.